Hi everybody, it's AJ speaking. Today I want to discuss the Rivian investment case. Today is July the 14th and Rivian's last closing price was $13.03. This values the company at $15.6 billion. In the following I will walk you through a detailed financial forecast which reflects everything Rivian management put out and leverages heavily my global automotive research. I will also use Tesla's historical development as a reference point for Rivian's outlook. I think this will be helpful to put what Rivian has to achieve into context. But before we dive into the financial analysis, let's have a quick look at this share price development. What you see in front of you is the year-to-date development of Rivian share price. You can see down here that it's down 2%, but you can also see that not long ago Rivian crossed into the $17 range, but lost all these gains in the last, call it 6 weeks. Since the year-to-date bottoming in April, up until the peak, there was no material Rivian news. My best guess is that there was speculation that the big beautiful bill would turn out much better for electric vehicles. However, that didn't happen. Also, this rally may have been connected to VW contributing capital to Rivian, since VW's latest capital injection was based on the average Rivian share price during this period. But that's a technical point and is actually not that important for the Rivian investment case. So now let's dive in. In this first chart you can see the forecast Rivian revenue projection, but you also see Rivian's historically reported revenue. For example, as of Q1 2025, Rivian reported 1.2 billion in revenue and reflects for the full year of 2025 just over 5.6 billion, implying a revenue increase year-on-year of nearly 14% from the just under 5 billion revenue that was delivered in 2024. Forecast then reflects a massive 44% year-on-year increase to over 8 billion in 2026, to another massive increase of over 75% in 2027 to over 14 billion. In the final quarter of the explicit forecast in Q4 2027, Rivian slightly exceeds 4 billion in quarterly revenue. This massive revenue increase is primarily driven by Rivian launching its first high-volume product, the R2. The R2 is a fully electric SUV that competes directly against the Tesla Model Y and similar electric vehicles in that segment. The forecast reflects that Rivian will position the R2 most likely at a premium to the Model Y. On this next slide, you see revenue broken down into the two main segments Rivian discloses. One is automotive and the other segment is software and services. This chart shows you the historical development plus the forecast up until 2026. I'm not showing here until 2027 to not make the slide too crowded, but these numbers will be shown later in the deck. You can see in this analysis how automotive revenue sees massive growth in 2026 driven by the R2 launch. The primary driver of the software and service segment is one, the VW JV, but then also the services and other part of the segment. By the way, here on the right side you always see Rivian's income statement, and the red boxes mark the line items in the income statement that are most affected by whatever is shown on the slide. So for this reason, here automotive revenue and software and service revenue is highlighted because this slide talks only about revenues. This slide splits the automotive segment into its subcomponents, which is one pure automotive, excluding credits, and the credits piece. The changes introduced by the big beautiful bill to US EV incentive subsidies have a big impact on Rivian. The impact is not very much on the current product lineup, but it is on the R2. Additionally, the BBB bill eliminates credit sales, and this was the primary driver of Rivian's recent gross profitability. So credit sales is pure profit. And you can see down here, this is year 2024, Rivian recognized for the full year a total of 325 million in credit sales, of which 299 million was recognized in Q4 alone. As I explained previously, this was no accident. Rivian had a very bad Q1 2024 share price was very low. So what RJ, Rivian CEO, did, he told investors that Rivian would become gross profitable in Q4, but he did not mention that this was entirely driven by concentration in the last quarter of credit sales. This is what you see down here. Then in 2025, RJ changed again his strategy, and what he did is he concentrated a large chunk of expected 2025 credit sales all in the first quarter. So Rivian guided for around 300 million in credit sales for 2025, and Rivian recognized 157 million already in Q1, so over 50%. The reason why you see 330 million in 2025 is the forecast consistently assumes very optimistic development in all metrics. I will explain at the end of this presentation why that is, and why this is a critical piece of this investment thesis. So why did RG concentrate everything in Q1? The reason is very simple. In the VW JV, there was a provision that the unlock of the next capital tranche that VW would inject into Rivian was linked to Rivian achieving gross profitability. By concentrating all the credit sales in Q1, RJ accelerated achieving that milestone, unlocked early that VW milestone and thus the funds. And of course, from Rivian's perspective, because Rivian is now short on cash, if you're a Rivian CEO, you want to secure the funding of your company as soon as possible, especially in currently uncertain times. I expect that Q1 25 will be Rivian's by far best quarter in all of 2025. So this was the right move by RJ, locking in this capital, especially now that the changes of the big beautiful bills had been signed into law. When you look at this credit sales breakdown, what you will notice that the forecast still includes slightly more than Rivian guided at the beginning of the year, before the big beautiful bill was known, even though the elimination of the credit sales kicks in after September. So this is again quite optimistic because it appears it's going to be unlikely that Rivian can actually recognize all the credit sales they envisioned at the beginning of the year. However, then from 2026, the forecast then reflects the elimination of US credit sales. However, there are credit sales in certain other jurisdictions that are available to Rivian, and this will deliver some modest credit sales revenue. I expect that Rivian will, because it becomes a largely immaterial item, eliminate credit sales disclosure pretty soon. So this slide breaks down the other main segment of Rivian, the software and services segment, into the services and other component and the VW JV. When we first look at the VW JV, what you see here is that there's a big spike in Q1. This is related to Rivian achieving early that VW JV milestone I just mentioned, gross profitability, that unlocked certain extra revenue, or I should say brought forward some revenue. That's why I expect going forward a lower quarterly number, because the way this is modeled is it's based on Rivian announced total expected revenue from the JV over a specific period. The forecast is also more aggressive here. The forecast, first of all, assumes faster recognition than what Rivian guided for. This creates quarterly a higher amount. And then also towards the end of the forecast period, the forecast assumes there is an expansion or extension of the VW JV. This is pure speculation and was not announced by Rivian. It's unclear whether it's relevant, but precedents in the automotive industry show that in most cases these JVs amongst OEMs that compete against each other typically end after a few years, or they are being scaled back significantly. Then down here you see the other segment. I will discuss this later in this presentation in detail, and this uses the Tesla services and other segment as the best proxy that we have. So this chart then dives into the specific modeling of the VW JV. We know from Rivian that Rivian received almost 2 billion, 1.96 billion in revenue for the JV period that Rivian told us they expect to recognize over approximately 4 years. And Rivian expects a gradual increase over this time period, a gradual increase in the quarterly recognition. The forecast, however, is a lot more aggressive. The forecast, first of all, assumes more than the 2 billion, almost 2.3 billion, and also the forecasting reflects recognition in roughly 3 years, so significantly faster than guided by Rivian. So this next slide shows the total gross profit development. So for example, here in Q4 2024, Rivian reported its first ever gross profit as RJ guided for in Q1 2024. But remember, 299 million, jumping back here real quick, you can see credits 299 million in Q4 2024 were the main driver of this 170 million of Q4. So if you strip out the credits, so Rivian would have been still 120 million roughly gross profit loss making. Then in Q1 2025, Rivian reported 206 million total gross profit, but here again, one-time effects drove gross profitability. Jumping back again here, Q1 2025, credit sales 157 million. And then there was this 214 million, what I believe an outlier recognition of VW JV recognition, which was likely at least 70 million above current normal rate. So together, both items added roughly 220, 230 million in, let's call it one-off or extraordinary revenue in Q1 2025. And Rivian's gross profit was 206 million. This means Rivian would still be gross loss making. Then if we move on to the forecast periods, again, the forecast is highly optimistic and results in gross profit in each of the remaining 2025 quarters, and then also consistent gross profitability throughout 2026, 2027, and then some meaningful, or I should say material gross profit in 2027 of over 2 billion, 2.2 billion. So if we stopped here, this would actually look quite good, but when you look over here to Rivian's income statement, gross profit is before research and development, selling, general and other, so all the operating expenses, plus ignores any non-operating income and expenses. And this is actually where the real next few years Rivian story sits. But before we move on from gross profit, let's look at what this means in terms of gross margin. So gross margin is simply gross profits divided by total revenues. And this chart shows you in blue the reported gross margin for available quarters, and then for the expected quarters, here marked with E, what the forecast implies. All the numbers that you see reflect this gross margin. And by the end of the explicit forecast, Q4 2027, the forecast reflects a 19% gross margin. The gray line shows you what the gross margin would have been if you excluded credit sales. I think this view is now quite important because it shows you, I think more clearly, that Q4's 10% gross margin and Q1's 17% gross margin would have been significantly lower without these extraordinarily high credit sales, as we just discussed. For example, in Q4, the gross margin would not have been 10, but negative 7%, and in Q1 it would have been 4% instead of 17%. This does not adjust for the mentioned, what I believe, outsized VW JV revenue recognition. Otherwise, this would also be negative to the tune of roughly 2%. Excluding credit sales, Q2 forecast would imply negative 1% gross margin, but reported margin, provided Rivian can still recognize some credit sales, roughly 4%. The dashed red line shows you actually Tesla's latest auto gross margin, excluding credits, excluding leasing, excluding FSD revenue, of 10.8%. This means that the forecast reflects a Rivian gross margin development that is significantly better than what Tesla currently delivers. This analysis is a continuation of the prior analysis and compares Tesla's development at similar size to Rivian's forecast gross margin development. So first of all, the top chart, these bars, show total revenue for Tesla and Rivian. This analysis uses a historic period from Tesla when Tesla generated approximately the same revenue that Rivian is forecast to generate at the end of the forecast period. So this is Q4 2027, and Rivian is forecast, Rivian in blue, roughly 4 billion. And what this analysis does, it looks at Tesla's development and looks at, okay, when did Tesla generate that much revenue, and then takes all the prior quarters, or not all the prior quarters, but all the prior quarters necessary to backfill this time series. And then in a second step, this analysis takes the respective gross margins Tesla reported and plots them down here. This is this solid red line that you see here. So this basically matches a historic Tesla with Rivian and tries to use quarters that in which both companies had like similar size at the end point. And what you can see is that Tesla was always at similar size, significantly more gross profitable than Rivian. There are multiple reasons for that. Number one, during these very high gross margin periods, for example, Tesla at one point had a 30% gross margin. There was very limited competition. The Model Y was miles ahead of everyone else in terms of range, charging, software, etc. The Model 3 as well, so a killer product portfolio. Nobody came close. Very few competing models, and this also coincided with various countries rolling out significant incentives for EVs, and there was in general a strong vibe amongst customers towards EVs. So Tesla collected all the earlier EV adopters. Interest rates were super low, and then the COVID affects supply shortages, which Tesla handled exceptionally well, drove vehicle prices higher. And this imbalance between demand and supply then enabled automakers across the board, not only Tesla, to generate extremely high gross margin by automotive standards. So in short, a lot of stars aligned for Tesla during this period. But unless we get another COVID type situation, which appears unlikely at present, Rivian will face, first of all, Rivian right now faces a completely different environment. Incentives are being dialed back, as the big beautiful build just demonstrated. There is now massive competition, and Tesla did not have to compete against an existing Model Y. So Rivian has a much tougher market ahead of itself for the launch of the R2. And I think this is also the primary reason why Rivian, from the beginning, never penciled in huge volume. For example, the first factory is only built for 155,000 R2 units annually. Despite all that, what you see in this forecast, in the last part of this analysis, you can see that the forecast reflects a gross margin that is exceeding significantly Tesla's current margin. So this is Tesla's total gross margin, for good reasons, which I'm not going to get into because this video would get too long. You see Tesla is right now, when Tesla had this size, Tesla was at a 15% gross margin, but the forecast project Rivian to exceed 15 significantly and end the forecast period at 19%. So all this is to show you that the forecast is really bullish about what Rivian can deliver. So now let's put this into the global automotive context. So this chart shows you the gross margin development on an apples to apples definition basis. Gross margin is often falsely reported, or not falsely but inconsistently, because some automakers include R&D expenses in gross profits. So they move this item over here, R&D expenses, above, not above, they move it into the cost of revenues category. So their gross profit is, let's call it artificially lower compared to automakers which do not include R&D expenses in cost of revenues. And that's why when you do this type of benchmarking, you have to make sure that you treat R&D expenses consistently. And in this analysis, all automakers that do include R&D expenses in cost of revenue, R&D expenses has been added or removed, and therefore the used gross profit is higher than what they report, and the gross margin is higher than what they report. This creates an apples to apples comparison. There's one exception. It has to do with automakers that report under IFRS, but it's a different topic and exceeds the scale of this presentation. the scope. So in this chart, we see again Tesla had phenomenal gross margins by automotive standards. At one point, exceeded everyone else except Ferrari. Ferrari is not included here because Ferrari is not an automaker. Ferrari is not selling products that provide primarily transportation. And you can see that if you look closely, in general, the trend was downwards. And as I just said, the forecast reflects Rivian to get to 19% in Q4 2027. But when you look closely, the ones that have higher gross margins or are somewhere near this level, these are first of all exclusively very large automakers, General Motors, Kia, Hyundai, Kia Hyundai is one company. Really, they're all under the Hyundai group, so they benefit from huge purchasing power. This is a key factor in the auto industry. Then there's VW, the largest automaker globally by revenue, number 2 by volume. Then there's BMW, a premium maker that actually is one of the best performing automakers right now, as you can also see here. Honda is also a very large automaker. Performs horribly operationally, but for other reasons. BYD gets a ton of subsidies, even at the gross margin level, let alone later in the P&L, but it's not a topic for this presentation. And then MBG is Mercedes-Benz Group, Mercedes 19.8%, and Toyota, by far largest automaker globally by volume, 18.9%. So basically, the forecast assumes Rivian gets to a gross margin comparable to all these massive automakers, exceeds Ford's, significantly exceeds Tesla's, even though this gross margin is on a total basis, which also includes the high margin energy business of Tesla, which is slowly getting to a scale where it's really pushing the needle, plus includes all the credit sales Tesla recognized in Q1. So again, this is just to hammer home the point that the gross margin assumption that you see in this model is very optimistic. If we go down this list, XPeng is one of the best performing new purely electric automakers in China. Nissan 12.1%, but they're in huge trouble, a very large automaker, but they have been in decline for many years. SAIC is basically the Chinese version of Nissan. SAIC is a legacy Chinese automaker, of which the heritage is making vehicles mostly in JVs with GM and VW Group. And then NIO, also a newer Chinese pure EV maker, doing really poorly and is in big trouble. And then Stellantis is basically falling apart. Stellantis is a fairly new but very large automaker that was created only 4 years ago from a massive merger of 2 large auto groups, but it's in shambles basically. So this next analysis breaks down gross profit by key drivers, and you can see immediately that first of all, automotive, excluding credits, deeply loss-making in 2024, generated almost 1.5 billion in gross losses, which is huge. The forecast, despite optimistic assumptions, expects that pure auto X credits is still meaningfully gross negative at negative 151 million in 2025, and then turns gross profitable in 2026 with the launch of the R2. Then here in the middle you see credit sales. Again, this is pure gross profit, so credits revenue and credits gross profit is the same. A huge driver, accounted for most of the gross profit, but it's significantly affected by the big beautiful bill. It's basically mostly going away. And then there's the software and services business, and as we discussed earlier, this includes the VW JV. The VW JV revenue is treated as a very high gross margin business, almost like software business, because VW basically pays Rivian for R&D services. In short, what Rivian does, it takes its current EE architecture and tailors it to an upcoming VW platform. My expectation is that then VW takes this over and rolls it out to the rest of the group. But this can be done then with very little or no involvement of Rivian. But please pay attention. This segment, software and services, will be, at least until 2026, most likely the main gross profit driver of the entirety of Rivian, with contributing 321 million in 2026, while all other segments contribute significantly less. So this analysis then just breaks down the gross profit contribution from the software and services segment. Again, this is to show first of all, this is to break down what happened historically. So from this Rivian's disclosure, you can derive that last year in Q4, when the Rivian VW JV was finalized, there was a payment that was reflected in this segment, and then from that we can back out what the rest of the service and others software and services segment generated, which was loss making, which is no surprise because this is basically Rivian's service network, supercharger network, etc. And then in Q1 2025, there was significant payment. Again, this was linked to the early achievement of gross profitability. Then Rivian could recognize here a significant amount. So this service and other segment, S&O, I will call it from now on, is very important to Rivian. And this analysis right here then tries to put this into context with how this developed I'm sorry, I made a mistake here. This analysis is now looking just at the service and other piece of the software and service segment, because this services and other is Rivian service network, supercharger network, etc., which is very comparable to Tesla's S&O segment. And what this analysis does is it tries to show you how optimistic also this forecasting is. So the solid blue line shows you the forecasts gross margin of this piece of the business, which turns positive around 4Q 2026, so next year. And then the solid red line compares it against Tesla, again with Tesla quarters matched, where the Tesla fleet and the projected Rivian fleet is comparable. And so the fleet size is here on the right axis, and it's these dashed lines, red for Tesla, blue for Rivian. And you can see in red Tesla's actual development, and then Rivian's forecast development. So the Rivian is forecast to generate a little less growth than Tesla at comparable fleet size, and this is primarily driven by Rivian is not expected to expand in overseas market and is therefore limited in North American market. Plus, there's now a lot more competition, as I mentioned earlier. So this is to show you again huge amount of optimism here in this forecast, because you can see Tesla actually experienced increasing losses in this piece of the business because Tesla was rolling out its service network, expanding superchargers, etc. Rivian, using the NACS connector, obviously doesn't have to build many superchargers because Rivian customers can rely on Tesla network. But Rivian, and as they announced, they intend to significantly increase their service network, the mobile network, etc., which they need, so customers will buy the R2, because if you buy an R2 and your next service center is 200 miles away, for some people is a big issue. But again, forecast projects positive development. So now we've finally arrived at operating expenses. Operating expenses comprise R&D expenses, and then it's called SG&A, so selling, general, and administrative expenses. And what you can see here, first of all, in 2024, so this operating expense often abbreviated OPEX, and so OPEX for Rivian was 3.5 billion in 2024, which is like an absurdly large OPEX base for a company generating the revenue Rivian does. It's absurd. And then in 2025, forecast expects significant reduction, even though Rivian is developing the R2 and also R3. Part of the reason is the effects of the JV, the way it works in this forecasting is that the JV is modeled as a meaningful reduction in R&D expense. So this results, as you will see later, in fairly little R&D expansion. And the forecast is very aggressive on SG&A expenses, keeps it relatively flat, but we'll dive into it in a second. And the two developments together translate basically into a relatively modest increase in 2026, even though Rivian is expanding its network, is launching the R2, which always comes with launch cost, and typically with a spike in R&D expenses and other things prior to launch, and then a rather modest 5.4% increase in 2027, even though, as you will see later, Rivian sells a lot more volume, and SG&A expense is highly correlated with volume. So this next analysis shows you how operating expenses develop relative to revenue. So operating expenses divided by revenue. At present, Rivian spends nearly 60% of revenue on operating expenses, which is like absurd, as I said. For the full year of 2025, it is expected to come down to 46%. For the full year of 2024, this was 58%, and with subsequent improvements in 2026 to 2027 to just 21% by 2027. This is basically entirely driven by revenue expansion, because, as I said, forecast expects relatively little operating expense increases. The dashed red line shows you again what Tesla delivered at the forecast endpoint size of Rivian, roughly 4 billion in revenue. So what this chart shows you is that the forecast reflects a Rivian that is significantly more efficient than Tesla was at the same size at the end of the forecast. Again, this is to hammer home the point that this is a very optimistic forecast. So this slide then breaks down operating expenses in R&D and SG&A. And as I said, R&D expenses are, because of the effects of the JV, are first assumed to go down in 2025, even though Rivian is developing the R2 and a bunch of other things, ADAS features, etc. And then there's an increase in 2026 prior to the R2 launch, and during the R2 ramping phase. SG&A, you see down here, 2025 forecast assumes a significant reduction. Optimistically, this is in parts driven by Rivian's guided lower volume for 2025. And then there's an increase in 2026, primarily driven by the R2 launch. So on this chart, we get to the core of the issue. This chart now shows the operating profit or loss, and you can see that in 2024, Rivian generated a staggering 4.7 billion operating losses. This, as I hopefully proved to you, highly optimistic forecast results in just over 2.7 billion operating losses in this year, in 2025. Operating losses projected to even slightly increase in 2026 to just over 2.8 billion, and then come down significantly in 2027 to 1.4 billion, but still 1.4 billion is still a huge amount of operating losses. And in the final forecast quarter in Q4 2027, Rivian is still operating loss making at nearly 160 million in Q4 2027, and again, this is on highly optimistic assumptions. Down here, you also see what this means in terms of operating margin. So in 2024, operating margin was a negative 94%. Forecast translates into 2025 operating margin of negative 48%, comes down to negative 35% in 2026, and then negative 10% in 2027. What we can learn from other automakers scaling up, especially in China, etc., when they're in deeply negative territory, what we often saw is more like an asymptotic approach to a slightly positive operating profitability. So you see, for example, from 2026 to 2027, here a massive increase of roughly 25 percentage points. The next step, you might say, if we have another such improvement in 2028, very highly simplistically, then we are well in positive territory. No, in reality, we have never seen this. It typically slows down, because to get even to slight operating profitability is a huge feat in the auto industry. The primary reason is that the technological war that requires such very high R&D expenses is enormous, and also automakers have to invest a lot in SG&A expense, need to provide competitive service, etc. And this just creates a very large minimum gross profit collection to cover these large operating expenses, and this just necessitates a certain minimum scale, and Rivian gets nowhere near the necessary scale to generate enough gross profit, and that's why the company will remain operating loss making. So this table then brings everything together. It shows all the key drivers: revenue, cost of revenue, gross profit, R&D expenses, selling, SG&A expenses, operating expenses in total. And then the operating loss, which is here labeled as loss from operations, it's the same thing. And you can see in the final year, every quarter is still significantly loss-making despite all these highly optimistic assumptions. Down here, you have a a trailing 12 months perspective. So trailing 12 months is just annualizing, not annualizing, but basically shows the last 4-quarter total. So here, as of December 2027, Rivian generates 1.4 billion operating losses. What does this mean for key metrics? So you see, I'm sorry, I have a typo here. It should be growth. You see that growth is projected to be very high, revenue growth. So this is also something to keep in mind for the investment case. I expect over the next several quarters recurring runs in Rivian upon announcement when the R2 launches, strong sales, etc. There's always a early launch hype in such vehicles that are hot. I have no doubt the R2 will be a very hot vehicle. There's a big fan community, but as this analysis showed, it's unlikely this amounts to very much in terms of financial effects. And this is the gross margin development that we discussed in great detail earlier. Again, this ends in 19%. OPEX, significant improvement, as you can see down here, but it's still not enough to generate any profits. Here the OPEX grows, as you can see, it's rather muted. Then the operating margin, again, still loss-making. This next analysis is the exact same thing, but this is now a break-even view, and it shows you what you have to believe in if you want to find out what would get Rivian by Q4 or in Q4 2027 to break-even point operationally, and you would have to believe in a 22.5% gross margin, assuming OPEX develops as this model forecasts. Jumping back real quick to this slide, so 22.5%, as you can see, Rivian would have to basically get to the peak of the global automotive industry effectively. They wouldn't have to beat everyone that is significantly larger, several times larger than Rivian. I think this is completely ridiculous and totally unachievable. But this is what you would need for Rivian to become gross profitable. So basically, to summarize current findings, you have to believe in Rivian generating enormous gross profit margins, or Rivian can slash operating expenses massively, can somehow develop new models, etc., with significantly less R&D expenses, and also ADAS features, etc., that will be seen more and more as indispensable by customers. I think in a few years, vehicle buyers will not accept a vehicle that cannot at least partially drive itself without reliably on the highway, etc. Rivian doesn't have such systems, has to develop it, etc. Have to buy it. All this eats into a gross profit margin, or they have to develop in-house, increases R&D, etc., etc. And or Rivian can somehow magically slash significant amounts of SG&A spend, even though they need a much higher network, much larger network. So the bottom line is, I don't see any chance for Rivian getting to anywhere near operating profitability at any point in 2027. So this next analysis then just plots what is needed in terms of gross margin development for Rivian to actually achieve operating profits, and you can see there's a quite material gap, even though this forecast is super optimistic. As we discussed earlier, it's 22.5% would be needed if you keep operating expenses constant, which appears highly unlikely. Then what about non-operating items? In Rivian's case, this has changed significantly over the years. So first of all, very quick recap, Rivian was the best funded EV startup globally by a huge mile. Nobody came even close. And this huge capitalization drove a huge cash balance on Rivian's balance sheet. The only downside was this was mostly during times of very low interest rates, so Rivian didn't make a huge amount of money from interest income on this cash balance, but this was a material driver of non-operating income. This cash balance has come down significantly. I'm not doing a capital discussion in this presentation because this would make this presentation way too long. I covered this previously in great detail, but the bottom line is Rivian's decreasing cash amount and increasing debt amount causes a situation where the financing income, so the net financing income, so the balance of income less expenses, will translate into negative net financing income, i.e. financing expenses. It is reflected here in the forecast. It's not a material driver. You have seen Rivian generates like 1.4 billion in operating losses in 2027. So it is not a material driver, but it adds to the, what I would say, mountain of pain that Rivian faces in terms of financials. So also not helpful. And then other operating items I'd like to point out in Q1 2025 significantly helped Rivian. So this large 107 million item is totally non-recurring in my opinion, because this was entirely driven by a valuation gain in an equity investment Rivian has. So Rivian received Series B preferred shares in a company called Also, and because the book value was only 3 million and the fair value of that was 104 million, Rivian recognized this non-cash gain of 101 million in other income. Again, this is also part of the reason why I predicted after the Q1, because of the high credit sales, the VW JV one-off high revenue, and this one-time equity gain recognition, that Q1 2025 will be Rivian's by far best quarter in 2025. So now if we add everything together, we arrive at this chart. This is profits or losses before tax and the implied margin. So you see in 2024, Rivian generated 4.7 billion in pre-tax losses. This highly optimistic forecast results in 2.5 billion in pre-tax losses. And in 2026, pre-tax losses slightly increase because of the factors that I discussed earlier. And in terms of margin, still looks basically really, really bad. So 95% negative margin in 2024. This year, 45% negative margin and a negative 34% in 2026. Then what does this mean in earnings per share? And there are some interesting effects. So first of all, you have the shareholders' net income, which is very similar to the pre-tax loss because there's effectively close to no taxation in Rivian because of ongoing losses. But then when you want to get to EPS, you need a share count. And so this model also reflects the announced VW capital injections, which create quite significant dilution, as you can see here. So if you look up here on a quarterly basis, you're talking, basically every quarter. The reason why these numbers jump so much, they reflect the timing of the announced injections. So there are certain quarters, for example, Q2 2025 will see a meaningful increase because this was the latest capital injections, 8% year-on-year increase. That's quite massive. And then there will be more in 2026 is also reflected here. There's another big jump, and there's some other dilutive instruments reflected here. But the long story short is, if you look at the latest reported 1.137 billion in shares, this goes up to approximately just under 1.6 billion or slightly over 1.5 billion shares by the end of next year, not 2027. Please take note of that. This has some interesting effects. Number one, these high losses, because the share count goes up, actually help reduce the losses per share, because you're dividing a negative number by a larger number, so the result then becomes smaller. So as long as earnings are negative, the dilution shareholders suffer from is actually helpful. But it's just pure optics, because the downside of that is obviously when Rivian becomes profitable, or if Rivian becomes profitable, the huge number of shares outstanding just creates very small earnings per shares. Even if you see 700 million in quarterly net income, it will translate into very little EPS and therefore imply a very high multiple. And we can do quickly a numerical example. So let's run real quick through a numerical example. Let's say Rivian gets to quarterly shareholders net income of let's say 150 million, and as you saw at the end of 2026, it's already above 1.65 billion shares. Let's say in the future it's at 1.7 billion shares. Then you divide. Then we annualize this number because it's a quarterly income number. So then we take the 600 million, we divide it by the shares outstanding, gives us this basically full year EPS number. then let's assume Rivian appreciates a little bit to $14. Again, we're talking like years out. So I mean, even if Rivian just trades up with the general market upwards trend, let's say 15 over, again, we're talking this is at least over 2 years out, $15. So even at $15, you have basically zero return, or highly unattractive risk-adjusted return from current 13 level. But even at this still very low level, what you would be looking at a PE multiple of 42.5 times, which is extremely high for an automaker, because Rivian simply is not a Tesla. Rivian does not have an Elon Musk premium, most successful businessman walking around. So people should not hope to get anywhere close to a Tesla valuation. And should Rivian trade up a bit, the multiple obviously gets even worse, and 150 or 600 million annual income is very hard to achieve if you, for example, now go back to this forecast here, end of 2026, it's a 600 million loss. So if we jump back to this operating loss analysis, you can see that at the end of 2027, Rivian would need a massive improvement of almost 800 million. And as we established earlier, to get to the break-even point, you need like ridiculous assumptions. So there is basically no chance that they get to this made-up profit. Here in this analysis, 150 million per quarter. Perhaps it's doable sometime in 2028 if everything goes really, really well. But think about it. This is 1, 2, 3, at least 3 years from now. Okay, so now we're at the end of the presentation, and I jump back to the story we slide with, and this is the Rivian share price development. So what's the Rivian investment case? I think it's an obvious short. There is I would not go long in this company. It's too risky, and for people who love the company or fans of the company, you have to consider the following. So Rivian has been absurdly cash burning. So this is the famous chart I often publish after typically when companies report it, and you can see as of latest financial reporting, which was as of Q1 2025, Rivian generated over 22 billion in negative cumulative free cash flow, which is like which makes Rivian a massive negative outlier, which shows you that what Rivian built was built on enormous capital waste, and these companies are fundamentally not good for society, because if everyone would be such a wasteful company, and I know a lot of customers love Rivian, but you have to keep in mind this was all, I hate to use the word, but it was all kind of a mind fake, because all this great Rivian stuff was bought for selling $2 bills for $1. It's just not sustainable, and for that reason, I think for the EV and automotive landscape, it's a good thing if companies that compete unsustainably just on shareholder money, cash burn, go away, is fundamentally good. It cleans basically the crop. Also, Rivian, for example, set unreasonable expectation amongst EV pickup truck buyers, because the Rivian scam, as I have to call it, was built on producing a product that looks superior to Tesla, so that it would attract more and more investor money. So Rivian did not care about whether the product can be made sustainably, and that's why even years after production launched, they could not make the R1 anywhere near they couldn't make it at a cost that was anywhere near the price for which they could sell the product. And this is why Rivian had to completely change the platform, the R1 platform, to the next gen platform only after 3 years, because what they built originally was not manufacturable at a price at a cost at which they can make money. This, as a result, then forced Tesla to significantly up their Cybertruck game, which then also translated in a product that is very hard to make money with. And that's fundamentally a bad thing for consumers, because ultimately we got these inflated EV pickup trucks that are now also expensive that most customers can't afford it. So if we look back at this analysis, this shows you the production cost of the R1 platform. So even after the refresh in last year, The Gen 2 is still extremely costly, and one vehicle on average costs over $114,000 in Q3. This is coming down now, but the vehicle is still more costly to produce than what it sells for. For example, when you look here, these are the average selling prices. Rivian did a good job selling higher and higher premium products, as you can see here on the higher selling prices. But again, this is to my point. Rivian basically increasingly, with the current lineup, is selling toys for wealthy people. And RJ once actually confirmed this point, but very few people picked up on it. He said that hardly any of their customers, I think only 45% or something like this, so less than half, ever charge on a supercharger. This means they use their Rivian just as a around town vehicle, which is fine, but it shows you kind of the toy nature of the product. And these average selling prices, historic prices here, just under 90,000, is well above what the average vehicle and even average pickup truck sells for. The EDV, so the electric delivery van, is similar. It does nothing to reduce emissions in deliveries, etc. It's complete overkill. It was also built to basically create the illusion of technological superiority by making a completely uneconomical product. But the forecast assumes with the R2, Rivian has to do away with all of this stuff, because the R2, because of the high volume and everything, cannot be made in an unsustainable manner, and this likely will result in a product that is very different from what current Rivian customers expect. They became conditioned to get a product for which they pay $1, they get $2, but the R2 will have to be, because of Rivian's massive cash burn and running out of financial resources, will have to be a product for the first time where the customer pays $1 for a product, but the product can only deliver 90 cents, and this will completely change the dynamics. So with that, we are at the end of this presentation of the investment case, which is a clear short. And in separate posts on X, I will present my best view of attractive entry points in a short, and what strategies should be used to build a short, taking into consideration market movements at the time and other changes. So with that, I hope this video was helpful, and see you in the next one. Bye bye.